Hey guys, it's Walker Deibel, author of Buy Then Build. 2 days ago, I did a live event, Deal Drop Live, right here on this stage at West Coast Finance Center in Carlsbad, California. Deal Drop Live had 3 parts. The first was me talking about pizza by the slice strategy. The second was Game of Money, delivered by Oren Klaff, best-selling author of Pitch Anything and Flip the Script. Check out this video of Oren giving Game of Money.
I mentioned I've been number 1 on every list, and so I don't want to, but I've been in more than 250 transactions. I've seen what works and what doesn't. I think more importantly, a deal I closed in 22, I used to say last year, but time keeps marching on, generated a more than $60 million win for the guys who invested. So what does $60 million really mean? And that deal's probably approaching $100 million in upside for those of us who invested and exited the deal. That was a 4X. And that number is really interesting, right? And the 4X is built around the game of money. So I'll show you why I think what we've learned is to target this 3 to 5X return. So when I think about it, there's rules. This is why I call it the game of money, because if it's a game of money, then there's rules. What are the rules? Well, first rule for me is not too early, not too late. What is this line? This is a capital appreciation line. So if you were buying and selling stuff during the everything bubble, 2020, 2021, you could buy a Michael Jordan rookie card for $100,000, and you would know that the next week or the next month you could sell it for more than you bought it, because that was an appreciating asset. It was on some kind of asset appreciation curve, and you knew just like, how much money do I want to make by holding this card, right? So that doesn't really work with assets anymore because we're not in the everything bubble. But I look at this as a revenue growth curve, which is synonymous with asset appreciation in private equity. So what I want to do is I want to capture this revenue curve. I want to trade in and trade out. So I think about it as the game. Then I want to trade in, trade out in a period that's sort of 18 to 36 months. Why? Because that is a family timeline, and I am a family. Walker's a family. A lot of you people in here, I believe, have families, but for a family, 18 to 36 months is a timeline. I want to trade in, trade out, move into my next thing, right? And so I think about it as a trade. I want to trade in, get on this revenue appreciation curve. I want to be 18 to 36 months in the asset. And the most important thing is I want to target a 4X on my money, your money. The reason is because, that's a good game. So if I put 100,000, I get a 4X, it's 400,000. If I can run that trade again, or that game play again, then in 18 to 36 months, and 400,000, 1.6 million, 1.6 million to over 6. And if I can run it a 4th time in my career, now I'm up above 10, 12 million, which I think where everybody wants to be super comfortable. So that's the game. How did I get so committed to this game? The slide sub up here, last year or the year before, I ran a deal in which I made a billionaire family office more than $100 million. And I've done that multiple times, and I'm just not doing that again. And I announced, if I can create $100 million wins, I'm going to do it for the Oren Klaff family and my friends and colleagues in the Walker. And for Gary, let's be fair, it's for Gary. And so we built a community around this effort. I announced I'm going to add $100 million to my own net worth because I've done it for so many other people over time. And so I have a real track record in the game of money. Walker says he's been 100 transactions. I've been 100 transactions, 250 transactions myself. And there's a pretty clear formula. I showed you step 1 in the formula. But the second step, or step 1.1, is I am not looking for crazy new tech to 100x my money. Because if it's a game, right, I'm not giving this guy, ironically, I'm criticizing people talking from a stage, but there's no red circle. But the difference is I'm talking about a 4X return, not a 1,000X return. I am not trying to go to Mars, right, for the Oren Klaff family, and I'll show you why in a minute, right? What I'm trying to do here, and so I'm not going to give some tech founder who's trying to change the world my money and let him run around amok trying to get a 1,000X or 0X as fast as possible. So this is maybe rule 2. Do not attempt to change the course of human history, your family's money. Do I want copper to be mined from asteroids? Damn right I do. We're running out of it here. I don't want criminals running around and stripping it out of the telephone poles or cutting my catalytic converter out. Let's get it from asteroids. Find it. But not with my money. Do I want talking robots to take care of grandma? and feed her breakfast while I'm at work. Of course I want that. Who wouldn't, right? But not with my money, because I don't know which robot company is actually going to win. Do I want flying cars? Since 1972, I have wanted a flying car and put $0 into that space, because my money can't get in and out of there reliably. I have no predictive elements. That is something that I would call get rich crazy. And these are the two strategies that most entrepreneurs, small balance investors get access to. So if this was AA for money, we would have to look in the mirror and say, I am a small balance investor. I am not a cashed up private equity group running around with $100 million, and I need to stop acting like I am. I'm a small balance investor with a family. I have short timelines. I want reasonable wealth building capability, but I don't want to do crazy. So what is crazy stuff? Battery tech, fintech, med tech, hyper drug tech, chip tech, AI, the AI of frying pans, right? Whatever it is. Are there any AI deals left to do out of the 3,000 we're done? So I'm not looking to do AI. Do I think AI is amazing? Of course, we use it every day. Should I invest in it? No. Get rich crazy. So, but this is what small balance investors see. And Walker and I talk all the time. If you see one of these deals, battery tech, fintech, crypto, med tech, chip tech. So, by the way, I'll ask you guys online later, but like, where did you guys come from? Who's not local? Who came from a different state? Where did you come from? Arizona. That's not a different state. That's California plus. You're out. You're out of the game. Who came from somewhere further than California plus? Georgia. Where in Georgia? Atlanta? I don't want to be rude about Atlanta. Very nice place. I've been there many times. But if you were walking around Atlanta and you find a battery tech deal, right, and you go, oh my God, look at this high-tech deal that I found, right? That deal fell out of the ugly tree, hit every branch on the way down, landed on the sidewalk, and you're like, oh my God, look at this high-tech deal. This is amazing, right? I can't believe I'm going to be able to 100x my money in something like this. I know, it's low probability. So that is the thing that small balance investors see, as I'll show you in a minute. The other thing, so this doesn't work out, because venture capital groups need to know how to do it. And Payman, you're on my team, so you can't make noise. It's okay if one of the guests do. And so the other thing that then investors, if they go, hey, I can't get rich crazy, then I got to get rich in the very, very high confidence way, and that's a 10%, like S&P funds, core bond mutual funds, core Manhattan infill real estate. That is so very slow, high confidence, but that doesn't build wealth. What is in the middle? That's the 4X. That's what family offices do. That's what people who are really in the game of building wealth actually do. I've helped family offices get very, very wealthy or more wealthy, and they're not doing that. It might look like they are, but they're putting a fraction of 1% of their money into that, right? They're putting a lot of their money into that, but this is what they're looking for every single day, and I've delivered a lot of those. If it's a game of money, there has to be a game board. Hey, Oren, what does the game board look like? It looks like this. So up here, you have 100x returns, 1000x returns, right? Those are awesome, right? We all want 100x returns. The problem is there's something down here called the valley of death. If you want 100x returns, if you want 10x returns, if you want 1000x returns, you have to live way down here where there is no revenue, no income, no predictable CAC, no product to market fit, lots and lots of problems, lots of opportunity, flying cars, talking robots, mine copper on asteroids, right? But you can live 2 to 4 years in the valley of death with a very charismatic tech entrepreneur or capital efficient entrepreneur. But the risk is incredible. How big is the risk? It's 1 in 3 million. So sure, venture groups are able to reduce the risk to 1 in 20, right? With the venture model, we can talk about that later. 27 billion up in smoke, according to PitchBook, right? In startups that will fail from about this time last year to this year. 50,000 startups going under, right? So we don't want to play the game of money in the valley of death. What we want to look is for something that's emerging. We want to trade in here when we have high predictability, and we can look at this curve and really believe in it. It's not a Michael Jordan card in the everything bubble. It's a real company that we understand the fundamentals, and then we want to trade out. So let's capture this, right? Let's trade in when it's emerging from the valley of death, and all that money is in and has got traction, everything like that, and it's coming up, and we want to trade out once we've been in it 18 to 36 months. It starts to flatten up, and that's what Walker and I are looking for, and what we're scrubbing the universe to find. I'll go to Mars to find that deal. Fortunately, I have to live in the valley of death to get to Mars, so I know they're not there, but they are here on Earth, and that is what can generate a 4x. Okay, so the lessons that I've learned, I've been doing this for 23 years in some form or another. Largely, I work for a billionaire family office in Beverly Hills. As I said, I've created multiple $100 million wins for people. I've been doing this for a long time. I started as an analyst. What I've learned is actual players in the game of money. I work for Bill Belsberg, a billionaire, corporate raider, and one of the first corporate raiders in Beverly Hills. And they spent all day long looking for 3 to 5x returns. They looked at every single deal in Beverly Hills, all kinds of tech deals, never did any of them, just looking for 4x returns. So they're not selling crypto. They're not doing crazy stuff. They're not starting venture firms, right? And they're not doing S&P 500 index funds. They're doing this thing in the middle, 4x. That is the sweet spot that family offices who are really looking to build wealth with the leverage of their relationships, putting their capital in judiciously, getting paid for their experience and other things that they do, are looking to do. So the reason that I play the game of money is this right here. This is my family. We live 6 miles from here in Southern California, and we have a capital-intensive lifestyle. Look around you. My friend came down from Hollywood. And he goes, "Oh my God, look at this place. You never go home, do you?" Well, I go home for dinner, but then I come back. So we have a capital-intensive lifestyle, and that requires me to play the game of money as well as I can, and I go hard in the paint every single day. Live in Southern California. My son is a hockey player. Anybody here have a kid in youth sports? What do you have? Softball, baseball, expensive. Are they traveling yet? On the cusp of traveling. All right. You, sir, need to be good at the game of money. Who else? What do you have? Gymnastics. Oh, yeah. Brutal. So gymnastics and hockey are good sports. I'm going to move quickly here, but because they're expensive, right? And so it's sort of, there's less people in it unless your kid get better. Oh, sorry, this might not be California politically correct, but there's less people in it because it's so expensive. It lets your terrible, obviously you've given your kid poor DNA, and so they need a chance to, as I did, so they need a chance to catch up. And so expensive sports are good because they are. So I have a capital-intensive lifestyle. This is my son, a hockey player. He's been hockey since he was 3 years old, right? We build an ice rink in our backyard here in Southern California, capital-intensive. There it is when you take, it's like a wet cat, right? Once you take all the clothes off and everything, that's what sits underneath all that hockey gear is like a little kid. So you also have to take care of that kid. But I want to tell you, when you play at a high level, it's not all fun and games. So I think it's fun, it's fun to show your kid like, scoring goals and everything. But that's also the reality you have to deal with. And so this is safety equipment, hospital visits, everything, right? Oh, by the way, this is my son, not this. There he is down there getting the spit kicked out of him. And so, we live in Southern California. It's super expensive to live here. We like to travel the world. That's the same photo, but it's taken in Italy, 9,000 miles away. That's a truck we have outside. We like to build motor vehicles, when I win a deal. And we also have them on a race team, so I fund that race team as well. Here's what a 6-year-old looks like driving a race car. So that all requires me to be good at the game of money. All right, so if it's a game of money, then there has to be players. Hey, Oren, what player are you in the game of money, right? So I am the banker. And I'll show you why the banker is the best position in the game of money to play. And I want to encourage you to step alongside Walker and I to play as the banker or in the banker position. I buy into companies approximately 2 years before they're sellable, and I target a 3 to 5x return. That's what bankers do, right? And that's enough for me to create actual wealth as I define it, to do the things you see here, to build this facility, and have the time today to talk to you guys. Okay, so maybe that's Moneyball. You guys saw the movie Moneyball, but as I define it, find 3 to 5x return deals before others do. By the way, a 3 to 5x sounds like enormous. That's a 34% IRR. So it's achievable. It's not like some kind of crazy thing that you can't hit. I put the deal together. We're going to come back to that theme in the 4x thesis, and I put myself and my investors and my friends and my colleagues in the deal in the best position. So what is the best position in the deal, right? Well, okay, guys, if you're on my team, you cannot be talking. Walker's team can talk. They're not used to being here. Hey, Walker, can you type more softly? I hear that. He's not listening. All right. He's like, my presentation is over. Why should I respond when my name is spoken? All right, the game of money. The game of money, I think, because we have to define it, is not like the game of business. The game of business is probably what you guys all do very, very well, right? That is having a product and service. That is having a gross margin, having salespeople or some kind of marketing, have a cost to acquire a customer, some ability to expand reach, the reach coming in salespeople converting at an attractive gross margin. Then you've got operating costs. So you have real estate or web operations, and you've got insurance, and maybe you have vehicles, if it's a small business, and then you have employees and HR and that kind of thing. And then so you've got a gross operating margin, then you pay yourself and your infrastructure, and then you've got a net operating margin. There's something left over, so you've got EBITDA, and then you have net operating income, and you take that income likely and take some for yourself, put into the business next year, expand your products and services, try and beat the competition, do better, to have a better gross margin, more organic cost of acquiring a customer, and just rinse and repeat until the things get big enough to sell. That's the game of business. Good game. But what happens is eventually people who play the game of business, entrepreneurs, operators, bump into the need of capital. And I have seen this 250 times, 1,000 times. When people who are good at the game of business bump into the game of money, they either lose everything, they get taken advantage of. I would say this, like investment bankers I know, they come into a deal that has been going on for 10 years. They get in that deal 6 months before it monetizes, before it gets liquidity, before it sells itself or takes in capital. The bankers make as much in that deal in 6 months, working 25% of their time, as the entrepreneur has done over his lifetime. Does that make sense? Because entrepreneurs are good at the game of business. They run in the game of money and they go, oh, it's just an expanded monopoly board. Right? There's a couple more Park Place, a couple different, community cards, but I can play this game. Why? Because entrepreneurs solve problems and they think they can fix everything. The game of money is anti-gravity, and it doesn't work the game of business the way the game of business does. I'm going to show you in a minute. The reason that I play the banker position in the game of money, bankers always make money in the deal. As an entrepreneur, in common stock, as a founder, as an employee, you are the last person get anything. Bankers always get guaranteed money. So bankers have cheat codes. Have you ever seen these exits where like, oh my God, like these guys were in this deal very short. They made $40 million, right? And they're in Silicon Valley. They're in Wall Street. You see it on the cover of, PitchBook, of TechCrunch or whatever. Like they have some kind of cheat codes that I don't have. They're getting the daily cheat code and they're reading it and applying it, and they're getting these huge wins, right? The game of money is played on a board you have never seen before by players you aren't familiar with, using rules that only insiders understand. And it's obvious that all the big money winners, all the guys who really win at the game, have some kind of inside cheat code. That's the game of money. So I've been around conference room tables like this, where executives are meeting and they are coming up with toxic cheat codes put inside a deal that you, given the number of people here and online, have invested in. Right? So what are those? Well, you're familiar. I'll give you a list of them: liquidation preferences, minority control, board flipping rights, drag along rights, all kinds of things that give people who have a little bit of money in the deal control of the whole deal. That is toxicity. If they can kick you out of your company very easily because you do one thing that is not liked, and then they can flip the board and you become the founder who is now the director of marketing, work from home, no direct reports, and somebody else is running your company, that happens every single day. I'm going to give you some examples. So what are cheat codes, right? So cheat codes look like this. You get $170 million of fees, then the deal crashes, and you take no reputation damage. That's a cheat code the bankers run every single day, and it's called Rivian. Anybody here have a Rivian? Do you mind stepping in the parking lot for a few minutes? You can drive that Hummer around. It gets 4 miles to the gallon. You don't mind taking and filling it up. In the meantime, we're going to talk about Rivian. I love those cars. I live in Carlsbad. It's the Carlsbad Camry. Everybody has one. Rivian delivers underwriters $170 million in fees. All right. Morgan Stanley, Goldman Sachs, JP Morgan. 19 other banks made $170 million in fees to the public. You got exactly zero of that, to my understanding. Me as well. I didn't get any of those. Right. Let's take a look at what happened. So here's the actual chart of Rivian. Right. Unlocked insiders trade the stock down from 172 to 28. Right here, way over here today. If you anybody invested in Rivian over here? Not even the Rivian owner? Turncoat. This is where all of us are sitting today who have money in Rivian. Bankers got paid $170 million. So look, here's the playbook of professional investors. The banks get their hooks into a deal. They grow that deal into widespread awareness. Then the banks give their best clients, in my understanding, I don't have the actual data from Goldman Sachs of their insider client roster, but my understanding of this, they give their clients access to the best shares, right? Then so these shares are represent the bank's clients, right? On the other side of this trade is retail. So this is a quick trade for them, right? So as the price runs up, they're transferring the insider shares that the clients got, family offices, guys I work with, to retail. Demand continues to rise, continue to see a transfer of shares until all the shares have been transferred, and then what happens? Boom. Retail has now paid these guys to get out, and they're stuck with the trade. That's the banker's playbook and why you don't want to step into these things. Not everyone lost money in this deal. The bankers and their best clients, I believe, likely got that IPO pop. Okay, so that's the game of money. If it's a game, there's players. I said I play the banker. Who are the other players in the game? You got the CEO. The CEO's job, the operator's job, is to take the investor's money and run the business plan. The investor's job is to write checks and ride along until there's liquidity. The employee's job is to follow the business plan as directed by management. And the banker's job, this is what I love. The banker's job is to set the rules of the game, coordinate the gameplay, and create a security which is then sold to the other players. And then the board of directors just hires management and makes sure the management is doing the job and following the business plan. Everybody else in the game is pretty much, from my perspective, a non-player character. NPC. Sorry to all you CFOs out there and operating officers and other players, but that's who the players are in the game of money. The banker, again, sets the rules of the game, coordinates the gameplay, he creates the security and sells it to the other players. That's why it's the best position money. I'll share with you guys how I think we play it together. But you guys know Jessica Alba? Use as an example. We have in our poll file 45 of these examples. I pull this one because you guys would know Jessica Alba, right? If I pull up some random executive, never heard of him, but Jessica Alba founded this company, The Honest Company. Anybody use Honest Company products? Yeah, we use them in our home. Yeah, great. So we have 10 people in here. We like Jessica Alba's acting. It's Honest Company. We like the products. My wife buys them and everything like that, and hope she does well with them. The day that I pulled the stock here, it's up now, but the day I pulled this slide, the market cap of the company was $104 million. Wow, good job, Jessica Alba. Probably made like $30 million in that deal. Again, it's up now. The problem is, according to PitchBook, you have a 2x liquidation preference. That means the investors who put $50 million in the deal get $100 million out before Jessica and friends get anything. That's the most classic cheat code loaded by professional investors in the entire playbook. Right? So Jessica and Alba and friends will get $4 million to split up among themselves because these investors will get a 2x liquidation. Right? So said another way, the biggest risk as an investor, as a small balance investor in a deal, is obviously the deal runs out 10 years and it's just blowing out your liquidity timeline. But other than that, the single biggest risk is that every other round of capital comes in on top of you has these cheat codes in them, and it limits your ability to get any liquidity. So, are there any other examples in history of this happening? I'll show you a few. But think about it this way. The largest returns of a deal are at the top here, the tranche at the top by the GP, as you can think about it, by the Oh, there's a recording of this. Are you? Oh, you're taking pictures. Yeah, no problem. Okay. I just, when I go to hockey games and I record, I can't watch the game. That's why I say that. But you can record. No secrets here. I am just, this is, we're interpreting the cover of the last 2 years of the Wall Street Journal here in a chart. So the largest returns of a deal are earned at the top. That is created by the bankers, which many of those returns are guaranteed, right? The problem is, me as a banker, I get in here, use a small balance investor, get in there at the bottom, right? And you're sort of have the Jessica Alba fate. Take a look at FanDuel. So I picked these ones because you guys are pretty familiar with it. FanDuel was sold for close to $500 million. FanDuel founders and most employees received nothing in this all-cash massive deal. Very typical once professional investors get in, load in these elements of toxicity. You've heard of unicorns. Obviously, the unicorn factory is closed. Let me tell you about unicorn meat. Unicorn meat is called Good Company. Good Company also was approaching $500 million in valuation. It dropped a little bit. It was sold. While bankers made millions, employees, some of who paid $100,000 in taxes on their equity, made next to nothing. That's how the game is played. So what are the cheat codes? And this is the slide we're taking a picture. I'll get it out of your way. But text it to me, will you? Thank you. I mean, I have the slide. You don't have to text me. I just want to see how good of a photographer you are, right? I absolutely have the slide when my laptop is charged. These are the cheat codes that I have seen put in deals dozens and dozens of times, right? Minority control of a deal. So somebody putting $1 million and controlling $100 million from the minority position. Liquidation preferences, as we went over. Board flipping. If I can flip the board, if somebody can flip the board on me, they control the company. I become the director of marketing. And if I sit there while they dilute the company with whatever money they want, and they control the whole thing. And drag along rights, determining when the company is sold and when it can liquidate. Professional investors load deals. We are small balance investors. You can write $100,000 checks, $250,000 checks, $50,000 checks, whatever it is, right? If we then subordinate ourselves to these cheat codes, big problems for our future. Said another way, biggest risk as a private equity investor is every other round of capital that comes in on top of you. That's why I play the game of money by investing in companies that have not taken professional capital. Are not loaded with the toxic cheat codes that I went over here, and we are not subordinated to capital stack. That's what the banker does. So, but it's exceedingly difficult for me and you to get in the banker's position, but that's where I always want to be. We just look at the deals that are in the market, right? We're stuck here at the bottom, right? Small checks. We don't own the deal. So if we want to get in a big deal that has scale, size, real probability to get to NASDAQ and liquidate in some kind of near term, the problem is our check doesn't matter. And we're stuck at the bottom, right? So how are we going to get in this top as a banker in a deal, right? Unless you're going to put the deal together as the banker. Remember, bankers make the rules of the game. Unless you're making the rules of the game, creating the security, what would your realistic options of getting a good deal? So this is really the crux of the biscuit. Switching out of the investor player to the banker player. And that yields the question, how am I going to get my money into good deals as a banker or from the banker position? So we have to overcome 3 problems in order to answer that question. 1, access. It is very difficult for us who do not run funds to get access to the deals. The reality is the cashed up professionals run around looking for 4x, 5x, 3x deals. They suck them up using their resources. We do not have access to the good deals. When we find a deal that is fully baked, ready to go, right? Just as we said before, whether it's Atlanta, who else came from somewhere that's not California or Arizona? Boston? Okay, there's deals in Boston. Who came from a point to far? Chicago. Okay, great. So the likelihood, I know the kind of deals that happen in Chicago. They're very, Pritzker family, very real estate centric, oil centric, manufacturing centric, right? Very hard to find a very a juicy capital intensive deal, in the Chicago zip codes, because we just don't have access to the kind of deals that are wealth generating deals are definitely there, but there's people who know how to do those deals and they have access. So very hard to get access to a deal. Analyzing a deal. I worked for 5 years as an analyst in a small venture group, private equity group, and the rest of my career I just ran doing analytics. So very likely, if a deal comes along, it's hard for you to run a stoichiometric regression and find a peer group basket of companies and the PE ratios as a public company and project the revenue of that company given the underlying assumptions and make a general analytic assumption from a spreadsheet and testing the assumptions in the real market. Hard for you to do in a fast-moving deal. So analyzing a deal is hard as a small balance, and check size. Why don't private equity groups like to take small, in real deals that have size, scale, and everything is baked in the deal? Why don't they like to take small check size? 100. What do you think? Too much manage, yeah. So like, hey, you've never invested this kind of deal before. You're going to be like that money's really important to you and your family. You're going to have an 18-month cycle time on it. You're going to be door knocking all the time. You're going to unionizing all the other small balance investors in it, and it just doesn't make sense. Too high friction. So even if you can find deals, even if you can do analysis on the deal, an underwriting on the deal, your check size removes you from access to that deal. And then you're back to being in FanDuel or Honest Company or Good Company or that kind of thing that can really have problems. So what is a good deal? That, to me, became the fundamental question. We developed an underwriting method called a royal flush. We're looking for a royal flush deal that is a 5-card deal. What are the cards? I want something that has a brand and product that is established. I am not good at inventing stuff. Every time I've invented stuff from Carlsbad, California, nobody else wanted it. So I want an established brand, established product that has product to market fit. I want a team that has done this before. With all due respect, young kids from Dartmouth, Duke, USC, Yale, Harvard, Ivy League, UCLA, and very good established schools who are 2 or 3 years out of school, great at problem solving, great at stuffing stuff into AI, but they haven't run this kind of company before up to $50 or $100 million. I want a team that's done it before, not just smart problem solvers, right? I want traction. I want numbers to look at. I want to be able to run a regression on traction. I want data that I can analyze. So I don't want to be guessing at data in the future. I want to look at data on the deal. I want a great story. I have sold some companies that are very complicated, B2B SaaS software in storage that retail consumers cannot understand within the scope of an hour. I want something that people can understand in 3 minutes. Great story, and it needs to have access to capital. That is a royal flush deal. So in that, as a startup or very early stage deal, right? A good deal in the game of money in terms of building wealth. Well, you have one card in an early stage deal. It's in the valley of death. I can't price that deal. It's a 1-card hand, and a royal flush is not a 1-card hand. So that is not a good deal. Problem is, when you're talking about royal flush as I've defined it, if you go to a private equity group, whether they manage $100 billion, $1 billion, you go to a venture firm, you say, hey, this is what I'm looking for in the royal flush. They go, whoa, that's what we look for. It's not like some kind of creative thing that I came up with, right? 5-card deal at a low valuation. Everybody wants that deal. That's why you don't see them. Think about it this way. Professional investors vacuum up all the 3 to 5x return deals that are easy. It's easy to analyze. It's easy to find. It's got a good management team, good product. It only needs a little bit of capital. It's got a great story, and it's got product to market fit. There's people who know what they're doing and looking for those deals every day with 10, 12, 15-person firms that are completely cashed up. They vacuum those deals up. You don't see them as a small balance investor. If you did, the check size is too small. And, of course, you don't know how to underwrite it, so you move too slow. The guys who know how to underwrite it will get that deal, right? So what is a good deal? Is there an answer for this? Here is what we have discovered. A workable deal has 3 cards, but 2 cards are missing. So in this case, say we've got the brand and product, we've got traction, there's a great story, right? But why is this deal available to us? Why can we put small balance checks in this? Why do we have the time to do the underwriting? It's because there's pieces missing. And the professionals go, there's so many deals out there, I'm not going to mess down at this level and do this much work. Professional investors managing $350 million looking for deals don't want to work or don't know how to do the work. Not in their mandate. Their mandate is to invest, not to work. So we're going to add team into this, and we're going to add some capital, right? So that's what we do here. That's what I've been done for 23 years. finding teams, bringing people to deals, going out and getting a little bit of capital. So if money makes this deal better and a better team makes this deal better, now we have created a royal flush deal from the banker position. That's how you play the game of money. Man, Oren, you are so smart. Did you win a Nobel Prize for this economic principle? Like, I'm just absorbing this, and yes, this really brings it all home. This is amazing. I mean, does anybody else do this? Like, economic principle is just seems so desirable. Like, who else knows how to do this? It's an entire industry called banking. Every single bank runs the exact same play. JP Morgan, HSBC, Bank of America, Wells Fargo, Goldman Sachs, Morgan Stanley, Citibank, everybody runs the exact same playbook. They're looking for deals in which the deal is, they've got to add something. And the interesting thing is when JP Morgan finds a 3-card deal and they add $100 million and they bring a team in and snap the story together a little better, Goldman Sachs is not buying that deal, right? Because the banker creates the security, puts the deal together, and sells it to the other players in the game. The other is the key word. Bankers don't sell deal to bankers. It's like Target doesn't buy toothpaste and then go over to Costco and go, hey, you want to buy some toothpaste? Costco's like, no, we get our own toothpaste. You have Colgate, we have Crest. That's the game of money. You got to find a deal and put it together. So you're not getting any banking deal when it's a 4X deal. You're getting it when it's a 4X. In other words, like you didn't get any of these deals, Snapchat, Tesla, what else is recent, Coinbase, anything like that. You are the bank's profit. They put together the deal, and then they profit by selling it to you, either in retail, or in the near retail. So where in the world could we play the game of money where we could find 5X returns, right? There's a glitch in the matrix, or what we call an air bubble or a dislocation in the capital markets. It's right here. So these are the bulge bracket banks. Here's the middle market banks, Jeffries. Here's the elite boutiques of California, Boston, Chicago, Austin, Los Angeles, San Francisco, right? Those are where the elite boutiques are. And then there's the regional industry boutiques who really know, like a certain, whether they know oil or they know movies or they know tech, something. So there's a dislocation right here that's a $10 billion space that I've been operating in, where we can actually play the game of money as the banker positioned together and win it. So here's where the air bubble is in that market. Right? Seed capital is over there. Seed capital needs $3 to $5 million. Venture capital needs $3 to $5 million, and way over here, growth capital, something ready to take off, typically needs $25 to $50 million, and these private equity buyouts need tons of money. Well, we already said we're not going to try and get rich crazy, right? By trying to get a 1,000x return. So we're not going to do seed capital and venture capital, and here's the dislocation. That is where we can play. That's where the 4Xs sit, and we can compete. What is in that 4X air bubble? You can come up with it. You can listen to private equity, middle market podcasts, and then we'll cover this exact same topic. Story is busted, 8% growth. It's off cycle. There's weak sales stories, mom and pop financial reporting. So the financials, are not digestible, and the cap table is messy. So if we can fix those things, but the other cards are good, then we have created a deal. If you want to read, read and see the ones that I've done that match this exactly, they're in Flip the Script, they're in Pitch Anything. I've done this many, many times, right? That puts the game in easy mode. How many of you guys here are video game players? Okay, great. No, it's good, because now let me explain to you how video games work. At some point, you're going to have a niece, a nephew, a kid, a son, and they're going to like, hey, come over here and play the game, right? The first thing you want to say is, I want to play in easy mode, right? Where you lose the game is you go, hey, man, how hard can this be? Let me set the game in nightmare mode and see if I can win it. Put the game in easy mode. That's what this royal flush lets you do. So let me try and summarize what I think easy mode is. What's a good deal royal flush? You've got a brand, team, traction, story, capital, right? It's got to be a serious company. We're not making robots. We're not building AI. We're not doing data sites for grandma. Like a serious company that makes something fundamental to the economy. Where can we triple revenues? Where can we double profit margin? Where is there a 36-month hold, right, where we can at least liquidate our position? And where can we get that 3 to 5x just affectionately calling it a 4x position, return on our money, right? And where can we do real work to make sure we're not putting money in a profession loaded deal that somebody else has cashed up? That's easy mode in the game of money. So the last thing is you have to understand is like it has to be on cycle. So this is how we got into the everything bubble, right? So we're in stealth phase. So this is what the good investors, the guys who really know looking at deals were able to do, right? Then they sold the deals. The guys who were in stealth mode and really found the good deals were able to sell to institutional investors. And then institutional investors, ran the deal out, loaded up with money. They sold it to the public. The public started feeling they could sell the deals to the early public felt that they were these guys, super professionals, and they started selling to the other public. Then we hit peak, and after peak, we hit contraction. Then we hit fear, capitulation, and despair, which is probably somewhere where we are now. If that feels like too much of a conspiracy, let's just go to the Encyclopedia Britannica, page 98. How do economies work? Expansion, 2021. Performers, information technology, fintech, communications, high sex, fancy stuff. Then we peak, hard to hire people. Everything is high priced, right? What is an outperformer? Well, financials and energy and materials. Then we peaked, then we got into contraction and we hit the trough, probably where we are now, trying to hit around the bottom of the trough. And then we're going to power out, right, into recovery. In every cycle that has happened, what is valuable in recovery? Real estate and industrial. So not only do you have to play the game of money with the 5 cards, you also have to have context of where we are in the macro cycle. So maybe that's the third or fourth rule is be on cycle. All right, so let me summarize in totality the banker's Forex playbook. Great deals are made, not found. The cashed up pros vacuum up all the easy wins. We're not capitalizing somebody else's high sex, high risk idea. And therefore, we're creating a deal and we're making sure that deal is on the next cycle. The everything bubble is over. We have to be on phase. That is the banker's playbook. All right. With all that said, are you guys ready to see a royal flush deal that matches this exactly as I've put it together? Great. Hey, thank you. So we're going to do that right now after a bio break.